This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
What's the old cliche? History doesn't repeat, but it does tend to rhyme? With the change in Fed policy, out have come all kinds of grand proclamations about what it means for the markets and overall economy. But as we've seen repeatedly recently, no precedent is foolproof in its predictive power. So up next, let's take a look at some context without locking ourselves into a firm conclusion. Welcome on board another edition of our Wise Investor Group podcast. I'm Simon Hamilton, Managing Director here at the Wise Investor Group of Raymond James. Very happy to be with you. All kinds of things going on in the world, including pretty significant change in Fed policy, which of course Chase Henderson talked about some last week, but it's such a big story. I'm going to continue that discussion a little bit into this week. But a bit of a sidebar, just before I get into that, I'm getting a lot of comments from clients, and understandably so, nervous about, hey, can this continue? It's been a good run in the market, right? What goes up has to come down, that kind of narrative. Well, history suggests that, hey, things could just be getting going. This is a young bull market. I read some data from Grant Hawkridge. He's a blogger over at All Stars Charts that I've followed for a long time. And he went back and looked at all the bull markets starting January 3rd of 1950, all the bull markets since then. And he suggests that the median bull market lasted 978 days, the average 1,131 days. And by the way, average return of those bull markets, well over 100%. Well, where are we today? Roughly, give or take, depending on your starting date, 488 days. Half of the median, less than half of the average. And we've only, I put that in air quotes, only had a return of 60%. So hey, it's been a good run. But by historical measures, this is a very young, immature bull market. Keep that in mind. And by the way, even if we are on the precipice of a collapse, obviously we're not going to like it, but if you're a longer-term investor, and I realize a number of our listeners are not necessarily longer-term investors, right? Maybe you're retired and your horizon's a little bit shorter. I get that. But, had you invested in 1999, which was arguably the single worst time in U.S. history to invest in the stock market, that was when the CAPE ratio, the cyclically adjusted PE ratio, was over 45, most expensive it's ever been. Yeah, and then you'd have to have gone through the dot-com bubble, right? The 2008 crash, the coronavirus crash, seeing the market get cut in half twice in less than 20 years, and a 4-week period during COVID where it went down by a third. Even with that, over that annualized period, it was 7.49% return for the S&P 500, according to FactSet. And if you look at all the other big peaks, historical peaks, going back to the September 1929 peak right before the crash. Again, according to FactSet, every 10-year period after those peaks has been positive, with the exception of the September 1929 crash and the March of 2000 dot-com crash. So, as we always say, historical precedent, no guarantee of future success. But even in those historical peaks, the returns over the ensuing 5 to 10 years, in most cases, were actually pretty positive. So, again, bit of a sidebar. And by the way, did anyone see this year coming? Well, if you're looking in the mirror, you probably didn't, right? In fact, right now, according to my own calculations here, the S&P is about 300 points above the highest year-end price target from Wall Street strategists, and almost 18%, maybe 19% above the average price target. So just remember that, because within the next couple months, we're going to start getting those, outlook, those forecasts for 2025. I wouldn't even read them. I wouldn't pay attention to them at all. Notoriously inaccurate. But let's get back to kind of the here and now. As I mentioned, Chase Henderson, my colleague here, did a really good job talking about the change in Fed policy, the 50 basis point cut the other day. I'm not going to get too much into the details on that, but I did want to say, I guess the broader point for me is, in light of this change in Fed policy, you've seen a lot of kind of talking heads come out, right? Telling us that this or that should happen based on historical precedent. Well, take all that with more than a few grains of salt. Just think of how many distortions we've had in the economy here over the course of the last few years. Fiscal stimulus, monetary stimulus, pandemics, right? As a result, a whole host of historically reliable economic and stock market indicators, they just haven't been that instructive, at least in isolation. Maybe collectively they've been instructive, but if you look at just one or two data points, they haven't been instructive at all for the most part. In particular, people worry about the fact that the Fed is cutting rates with the market at or near all-time highs. Doesn't happen that often, but it does happen a little bit more often than you think. I read some data from Ritzold Asset Management. They looked at forward returns from the first Fed cut. Again, the Fed just cut rates, as you know, a week and a half ago. So specifically forward 12-month returns from Fed cuts. And what did they find? Well, they found that most of the time, returns were pretty good. Most of the time, returns were pretty good. In fact, 5 out of 7 times, specifically when the Fed started cutting rates near all-time highs, the market was higher 12 months later. Then they looked at 3-year forward returns. Again, pretty good batting average. 6 out of 7 times, and by the way, this goes back to 1957. 6 out of 7 times the stock market was higher 36 months later when the market was close to all-time highs. So this is pretty good news, right? Most of the time, things have worked out just fine when the Fed cuts rates close to all-time highs. But the caveat here is we're living in unprecedented times, right? We're still normalizing from the pandemic. We've seen trillions of dollars in government spending. We've been in, depending on where you define your stop and start dates, you've been in sort of an extended bull market for almost 15 years. Interest rates have been all over the map. We've only experienced 2 months in recession since 2009, which is one of the longest periods ever, really, without a significant recession. So be careful buying into projections and extrapolations. But I do think it's helpful to know that Fed cuts at and around all-time highs have not spelled doom in the past. And I think it's also true, that the stock market has been up more often than not over most 12 to 36 months. So maybe this is just telling us that it's not different from any other period where the market goes up most of the time. 3 out of 4, years historically. So just wanted to give you a little bit of perspective there. I think it's also important, maybe not as much to kind of our day-to-day portfolio management, but I think it's important to think about what the Fed rate cut means for the economy. Because, again, you're seeing a lot of kind of truisms come out, or proposed truisms, right? That, well, when the Fed does this is what it means for the economy. Well, history has shown something different. History has shown that there are very few certainties with respect to Fed policies. So why don't we talk about that just for a minute? And again, I'll reference some data from Ritzold Asset Management. They had a really good piece on this just a few days ago. And what they kind of did is looked at what Fed rate cuts don't mean. 1, fake rate cuts do not necessarily mean a recession is coming. There's been a lot of talk about that the Fed knows something that we don't, that they're cutting rates because they're anticipating a significant downturn in the economy. Historically, it has not meant that. Yes, it is true that sometimes the Fed's forced to cut rates because of a financial crisis or a slowing economy, but rate cuts in and of themselves don't just happen during a slowdown. If you look at every Fed rate cutting cycle going back to 1970, there have been a number of times where there was no recession over the next 12 months. 1971, October of 75, August of 76, September of 84, October of 87. Most recently, July of 1995. In fact, there are a lot of people that are comparing this period to 1995, which of course was just on the doorstep of a major bull market over the ensuing 6-7 years. So yes, like I said, it's been a while since the Fed went on a rate cutting spree outside of a recession, but it does happen and it has happened quite often. How about rate cuts don't mean inflation is coming back? There's been talk about that. The idea that if the Fed cuts rates and makes money easier to obtain, that could incentivize demand and we're going to have a spike in inflation. that inflation will rear its ugly head again, just as we've gotten it under control. Well, again, anything's possible, but I'd be dubious of people predicting higher inflation from interest rate cuts alone. Just look at the recent history. We learned in the 2010s that low rates from the Fed do not necessarily cause inflation. I mean, we had 0% rates for years following the great financial crisis. Rates averaged less than 1% in the 2010s, yet the inflation rate for the decade was under 2% for the year. How about rate cuts don't put a floor under stocks? Also important. I think there are a lot of, I don't want to say they're conspiracy theorists, but there are a lot of people out there that assume that the market's only done well because there's been kind of a Fed put in place that, first sign of any trouble, the Fed's going to come in. And that's why stocks have done well for the most part over the past 15 years. Well, I mean, just look at the last couple of years. We just went through one of the most aggressive rate hiking cycles in history. Stock market's held up just fine, right? The Fed first began raising rates on March 17th, I think it was. Yeah, March 17th of 2022. Yeah, obviously we've seen some volatility along the way. The fall of 22 is lousy. But since then, since they started rates, the S&P is up roughly 35%. Again, this is from some data from Ritzold Asset Management. That's pretty darn good. And I think it should also be instructive, potentially instructive, on the other side of the equation. The stock market can do just fine during a rate cutting cycle. But I don't think it means that the Fed cutting rates, somehow better protects the stock market against risk. I'm not sure I buy into that. Low rates don't guarantee the stock market has to keep going up. Last thing I'll say on this is rate cuts don't guarantee bond gains. And I know that may sound a little off, if you will, for lack of a better word, just because I've been talking about how it might make sense to consider, bonds in the portfolio to a greater extent than maybe you've considered in the last few years. But I do think the rate cutting cycle will be a little bit more nuanced than what a lot of people are saying. So, a lot of the headlines suggest buy bonds because rates are coming down. But remember, short-term rates have been higher than long-term rates for a while now. We've had that inverted yield curve, right? And I will tell you that bond yields have already come down a fair amount in expectation of rate cuts. In fact, I believe this is the 5th straight month that treasuries have had positive returns. Market's forward-looking. It's not going to wait around for the Fed to move. It moves before they do. So what happens if intermediate and long-term rates don't budge all that much as short-term rates fall? And the yield curve, what they call disinverts, meaning going from being inverted to re-steepening. Those rates never rose as much as short-term yields did in the first place, right? Now, if we do go into a recession, or if inflation falls dramatically from here, I do think you would see bond yields fall across the board, but bond yields aren't guaranteed to go down in this kind of soft landing scenario that we've been talking about, where the economy cools, but we don't actually go into recession. So I'm not being negative on bonds. I'm just saying the actual results here the next couple of years might be a little bit more nuanced than just, the Fed's cutting rates, bond prices are going to go up. I think you'll see different reactions, if you will, at different parts of the yield curve, short versus intermediate versus long. So the good news is bond yields are still pretty good, right? They're still much better. Yes, they're below where they were, for the most part, below where they were a few months ago, but they're still much higher than they've been at most points in the last 10 or 15 years. So rates don't have to fall really at all for bonds to offer reasonable returns, especially relative to inflation. But I do want to talk a little bit more about bonds, just to change gears a little bit. So I'm going to get away from the Fed cuts for a second and talk a little bit more about bonds, and not extensively so. But there's been sort of a cliche out there, or kind of a hackneyed throwaway phrase out there called T-bill and chill. That the ultimate no-brainer for a lot of investors has been just park your money in T-bills and you'll be fine. You'll collect your 5% without any risk. And I think, there's been some merit to that, especially with inflation falling. The real rate of return on short-term treasuries has been positive for much of the last year, right? But what do we also know? We know that the Fed cut rates 50 basis points the other day. And if you believe the futures markets, which you maybe shouldn't believe because expectations for rate cuts have been all over the place the last couple of years. So, don't buy too much into them. But based on what we know today, the Fed futures are suggesting another half-point cut this year and then a full point cut next year, to the extent that by the end of next year, the futures markets are pricing a Fed fund rates in the 2.8% range. I'm not saying that's going to happen, but that's what the futures are saying today. So as you need to know, rates on cash, savings accounts, CDs, T-bills, money market funds, other short-term, safe, liquid vehicles are undoubtedly going to come down, and I would say they've already have come down. Maybe your bank hasn't called you and told you, but there's a good chance they've slashed your rate already. Okay? So what to do now? Well, I will say this. I read something from Vanguard just this week that says investors really shouldn't worry that they've missed out by not putting some of their cash to work already in the bond market ahead of the first rate cut. A guy named Chris Tidmore, who's a senior manager over there, he said that if you believe the Fed's going to continue to cut rates, treasuries historically have still paid off. And he specifically references the 5-year treasury and says that the 5-year treasury has outperformed cash in 16 of the 17 past rate cutting cycles from the Fed. 16 of the 17. And in 6 of the last 7, the outperformance is more pronounced. Now, as I just mentioned a minute ago, he's specifically talking about the 5-year treasury. There may be a different experience, with longer term treasuries. But still, if you're sitting there saying, oh man, I really should have moved some of my cash into bonds, I don't think it's too late, particularly if you look at corporate bonds that are yielding, even investment grade corporate bonds are yielding in many cases above treasuries. And if you're willing to go out further, as I've talked about on previous shows, the municipal yield curve, tax-free bond yield curve, is a lot steeper than both corporates and treasuries, meaning the further you go out, the more you are compensated for that. So you combine that with the fact that tax rates could go up, longer-term municipals could make some sense. So I'm not offering any strategy here. I'm really not. I mean, the decision on how much cash to have is very nuanced at the individual level. There are a lot of reasons to hold cash. Plan to purchase, upcoming obligations, you're drawing from the portfolio, want to have a fair amount of liquidity. You need to be able to sleep at night. For some people, that means they need to have a certain amount of cash on hand. I get all those things. But I think what you need to think about is what kind of excess cash do you have? Is there cash beyond those requirements that maybe needs to be allocated somewhere else? Here at the Wise Investor Group, historically, we try not to get too caught up in interest rate forecasting. That's not our bag. And I don't know if it's anyone's bag, to be honest. I mean, earlier this year in January, the market was predicting 6 or 7 rate cuts. Well, they just cut rates for the first time a week and a half ago. All right, so I'm not sure it's anyone's bag. So by being agnostic, what we've traditionally done on the bond side is just kind of laddered out. We'll have some short-term bonds, we'll have some intermediate-term bonds, and we'll have some longer-term bonds. I would say now we're probably going out a little further than we have historically because we want to lock in some of these yields. But that way, you're kind of agnostic as to where rates go. If rates go higher, okay, well, the shorter-term ones, when they come due, you can reinvest into higher yields. If rates stay the same or go lower, well, the shorter ones, you have to reinvest those at lower rates, of course, but the longer term ones, you've locked in a higher yield. So you're kind of hedged in both directions. Again, I'm not really offering a strategy here because it does depend on your individual risk tolerance, your individual financial situation. But my advice might be to not get too caught up in trying to predict where rates are going to go. Stay away from the headlines with respect to that. But as the gentleman at Vanguard suggests, maybe it's probably also not right to say that you've missed the party at this point. Okay, and the other thing, of course, is we're up to something like 6.7 trillion sitting in money market funds. As the guys and gals at Ritzold Asset Management point out, that money will not necessarily come back into stocks. In fact, they looked at all the down quarters in the stock market going back 25 years, actually going back further, going back to 1974. And you were actually twice as likely to see assets flow into money markets in a down quarter than out of money markets. So I'm not necessarily convinced that if we saw a down stock market or, a correction in the stock market, that money would come off the sidelines into stocks. But I could see, and this is not a prediction, this is just a speculation, I would not be surprised to see money come back into bonds, because I think a lot of the money in money markets came from bonds. People suffering losses in bonds and saying, why am I doing this? With the Fed raising rates, why don't I just get 5% in the money market? So, if money market rates are starting to fall, cash rates are starting to fall, I would not be surprised at all to see some of that money find its way back into the bond market. So keep that in mind, folks. Just a couple thoughts here on the stock market, sort of general thoughts. I've talked a lot about this over the last 6 months, that, people talk about the Fed, people talk about expectations for the election, people talk about a lot of macro reasons for why the stock market's gone up this year. I think the biggest reason by far is that earnings have been better than expected. In fact, according to Strategas, when grouping the S&P into quartiles by earnings per share revisions, analyst revisions, on average, the companies with the greatest positive revisions this year have also been the top performers. So, in other words, stock prices or by extension investors are, for the most part, some exceptions, but for the most part, directly responding to which companies are raising their earnings estimates or having their earnings estimates raised by analysts. So earnings have been the biggest determinant of performance this year. At least that's what the statistic says to me. And related to that, you're starting to see earnings broaden out. If you look at, according to FactSet, the last 12 months worth of earnings compared to the next 12 months of expected earnings, the last 12 months, it was completely dominated by tech, information technology, and communication services. Industrials, distant third. Sectors like materials, utilities, energy all had negative earnings over the last 12 months. But if you look at the next 12 months, the expectations for the next 12 months, IT and communication services were still positive, but the gap has closed materially. Industrials, materials, utilities, energy, healthcare, all expected to have earnings growth that is much closer to what is expected from IT. So I don't think it's an accident here over the last couple months that tech has not done as well on a relative basis, and you've seen other sectors in the market start to recover. BMO's Brian Belsky, he said this week that, quote, "It is no secret that a handful of mega cap tech stocks have been the driving force behind market gains for much of the past 2 years. However, these stocks have underperformed the rest of the index for the first time in nearly 2 years. And that's because earnings are starting to broaden," end quote. Okay? So that's something that we're going to be watching for over the next few weeks. It's ebbed a little bit just this week. As I think some of the news out of China, some of the news from some of the semiconductor stocks has reinvigorated that tech trade. But still, that's been the overwhelming shift over the past few months, is that broadening. Strategas notes that only about 30% of semiconductor stocks, chip stocks, many of which are highly correlated with AI, are above their 200-day moving average, which is a pretty well followed, if you will, measure of sort of intermediate term momentum in the market. And tech is not even in the top 5 of best performing sectors over the past couple months. I'll also say there's some macroeconomic underpinnings for this. According to Strategas, this what they call the uninversion of the yield curve, so going from being inverted to re-steepening, where longer-term rates start to become higher than short-term rates again. That has historically benefited more defensive sectors. Again, sectors beyond technology, like consumer staples, for example, like healthcare, like utilities. And they also note that defensive sectors perform the best on average once the Fed begins cutting rates. They went all the way back to 1974 and found that. So from a macro perspective, from a technical perspective, from an earnings sort of fundamental perspective, you could see maybe not leadership, replacing technology, but other parts of your portfolio start to do well. And certainly, I think dividend payers could be a part of that. On top of that, if you look at where a lot of the big dividends are being paid, it's in some of these other sectors, right? Healthcare, utilities, REITs, consumer staples. And it's pretty logical to think that as interest rates come down, that dividend yields will be more competitive versus what you can get in bonds and money markets and cash, right? When you can get 5% in a treasury short-term T-bill with no risk, why buy a dividend-paying stock paying 3% with a lot of risk? And I'm not saying that's the way we think, but I could see somebody thinking that way, right? Well, as rates come down, that's less of a trade-off, right? Strategas notes that if you go all the way back to 1990 through a month ago, the annualized return on dividend growers, so not just companies that pay dividends, but companies growing their dividends, is a little over 12% annualized. Companies with no dividends, 11% annualized. Dividend cutters, less than 11% annualized. But this is also important. The standard deviation on those dividend growers, a little over 15% annualized. No dividend, about 22%. So, according to Strategas, companies growing their dividends have had better performance with less risk going back to 1990. And I think what's also instructive is the percentage of their total return that comes from dividends tends to vacillate from decade to decade. I mean, so far this decade, roughly 15% of the total return in the S&P has come from dividends. Well, last decade, it was about 26%. Again, this is Strategas data. But other decades, it's been much higher. I mean, that lost decade, the decade between the dot-com bubble implosion and the financial crisis, dividends were 100% of the return. Because the price move on the S&P was negative over that 10 years. All the return came from dividends. Go back to the 70s, 77% came from dividends. So it would not be surprising when you consider that on average, dividends have produced about 59% of the decade-by-decade return in stocks. Not be surprising to see dividends have a much higher percentage of the return going forward. So again, this is not a prediction. It's just looking at some of the precedent and looking at that there are a number of forces that may play into that. I would just say, take a look at your portfolio. Do you have balance? Are you all in, AI stocks? Are you all in growth stocks? I wouldn't shoot you if you did, because that's where a lot of the best performances come from the last few years, right? We've talked about the S&P 500, U.S. large cap growth being far and away the best performing asset class in the market the last few years. Wouldn't be surprised if that changed a bit, if leadership shifted a bit over the course of the next 12 months. Just consider that when you're considering the balance and diversification in your portfolio. Up next, stick with me. Don't have a whole lot to say on the individual stock front today because we're just on the doorstep of third quarter earnings reporting season. I'll have a lot more for you over the next few weeks on that, but I do have a few notes I just wanted to share. Back in a second.
Will the Magnificent Seven continue their spectacular run? Be careful relying too much on last year's playbook. Tune in every week to hear Simon Hamilton and Chase Henderstein discuss the latest financial trends and what investors need to know. To learn more about some of the most important planning topics to consider and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
So a few of our stocks have been in the news recently. And as I always say, remember, all the names I'm going to mention today, I own personally in my own portfolio. We also own for clients. So that represents a conflict of interest. You need to weigh that in your decision making. If you are a client of ours, have confidence that we've done our due diligence and we feel that these are suitable for your portfolio. If you're not a client, you really need to do your own homework. I can't manage your portfolio through the podcast. So you need to make sure you do your own homework, your own evaluation, speak to your own advisor, make sure it's right for you. But yeah, as I mentioned, a few stocks in the news. One is a new addition to our portfolio, Nike, symbol NKE. I think you all know Nike. I understand Nike's been a bit of a controversial name over the past few years, more from a cultural perspective than a financial perspective. From a financial perspective, it's been a terrible company the last few years. Well, I shouldn't say a terrible company. It's been a terrible stock the last few years. Up until recently, it had been down almost 50% over the last couple of years. One of the worst performing large cap growth stocks in the S&P 500. But we took an interest in it recently after their most recent earnings miss, if you will, where the stock dropped precipitously, mainly because we felt that the stock has the potential to kind of change the course that they've been on. The analyst here at Raymond James noted that, during the COVID shutdown, they transitioned their focus pretty significantly to direct-to-consumer channels, right? Online shopping. And that was successful for a period of time, but the RJ analyst noted that they sort of neglected some of their traditional agreements. They discontinued relationships with some of their retail partners, for example. And now that we're in that kind of, a much different environment where people are going back to the malls and people are going out, out and about and shopping, Nike's been left, no pun intended, flat-footed. But the reason I mentioned Nike today is they made a significant management change. John Donahoe, who is the recent CEO, is going to retire. And they're bringing back Elliott Hill, who is a veteran of Nike. And he was with Nike during some of the best periods that they've ever had. He, in fact, was there in 1988, started there as an intern, and he was one of the main guys responsible for helping the company grow their brand. I mean, he led all the commercial and marketing operations for both Nike and the Michael Jordan brands. Okay, so he was there during the Nike heyday. And, because he has that experience, he is going to be tasked with, kind of rebuilding that wholesale business. And so Nike's stock has responded well to that. On the flip side, nothing's happened yet, right? There's still a lot that Nike has to do to reinvigorate the brand, reinvigorate those sales channels. I do think Nike is, quote unquote, less cool than they used to be. A lot of up and coming brands have taken shelf space from Nike. So they have a lot of work to do. And so I'm not saying to any investor that Nike's going to have an immediate financial turnaround. And so you have to be patient with the story. But considering they're trading at one of their lowest multiples relative to the S&P pretty much in the last 30 years, the risk reward may be favorable, but you have to be patient. So I think it's interesting and worth your consideration. A couple other names that were in the news, Johnson & Johnson. You all know Johnson & Johnson. About a week ago, they announced that they've reached an agreement for what they call a prepackaged bankruptcy filing regarding ovarian cancer arising from their talcum powder litigation. If you know anything about Johnson & Johnson, you know that has been a major overhang and in litigation for years now. And essentially what this means is roughly 83% of the claimants support the agreement. Doesn't mean there will be an agreement, but means it's more likely there will be an agreement. And essentially the way that looks is they're advocating for an $8 billion trust, which is an increase from the previous proposal, an $8 billion trust that would be paid out over 25 years to claimants. Okay? So what does all this mean? Well, obviously, the obvious risk is this may not happen, right? The courts may not approve it. But the fact that they had such a high acceptance rate of the proposal means that it's more likely than it has been in a few years. And it's certainly not an immediate elixir for the stock. Johnson & Johnson has other issues to contend with. However, this has been a major overhang on the valuation, I believe. They're down to less than 15 times earnings, which is the cheapest it's been in a long time. Again, the analyst here at Raymond James thinks that just that alone could allow the stock to drift back closer to traditional multiples of more like 16 to 17 times earnings. So Johnson & Johnson, if you're a holder, this should maybe give you a little bit of confidence that the stock can start to get a little bit more attention. If you're not a holder, it might be something for you to take a look at, but understand the risks that this is not going to immediately drive the multiple and the execution of Johnson & Johnson higher. It's just removing some overhang. Related to Johnson & Johnson, remember they spun off their consumer health business, which includes everything from Tylenol to skincare products to talcum powder, by the way, as KVUE about a year ago, right? And that initially didn't go so hot. KVUE was spun out, I think $26.50, I believe, $26.50 a share, now down to $23 a share. It had been in the teens. So the spinoff did not go well. They are the largest consumer health company, freestanding consumer health company in the world. And they had a lot of problems. I think, I have 3 teenage daughters, and I can tell you how enamored they are with skincare products. There's been a huge surge in interest, particularly from teenage girls in skincare products over the course of the last couple of years. Any of you with teenage daughters or granddaughters knows what I'm talking about. But KVUE was late to that game, and they lost a lot of shelf space, and they've put a lot of money back into reinvigorating some of those brands. Goldman Sachs came out just this week and said they really think that that's going to start to show up in sales. Their margin execution has been a lot better than expected as well. The key point on KVUE is they're trading at about a 6, maybe 7% valuation discount to their peer group. So the execution problems they've had, Goldman Sachs believes are reflected in the valuation at this point, and that KVUE could perform better. So whether it's Johnson & Johnson, the former parent, or KVUE, the current spinoff, both of those look interesting, although both have risk factors that you need to consider. The last thing I'll mention today, and I'll have more on this over time, but just because a lot of the details are still unclear, but Visa was hit with a U.S. Department of Justice antitrust lawsuit this week, caused about almost a 6% drop in the price of the stock. This is not a complete shock to anybody because I know that there's been concerns about Visa having monopoly over certain parts of that industry for some time, although I do think this lawsuit is a little bit broader in scope than what some people had thought about. I'm not going to get into all the details today. Goldman Sachs noted this week that a lot of it has to do specifically with their debit cards, not so much their credit cards, that there are fees on Visa products that are getting passed along to consumers that they essentially have full control over. And it's a lot more nuanced than that, but that's sort of the simple or the straight picture on it. So what does all this mean? Well, I think what the market did this week with that 5 or 6% hit is they priced in some market share loss in the debit card business. The analyst here at Raymond James, he sort of did some rough math, and he thought that a 20% reduction in U.S. debit card revenue would equate to about a 2% revenue hit on Visa and a 3% earnings hit, which is not, inconsequential. But the analyst at RJ felt it could be made up in other areas. And he also noted that debit cards is one of Visa's slowest growth markets, lowest margin markets, and that a lawsuit could take many years to play out. You saw that with MasterCard, that they were hit by something somewhat similar, took years to resolve. So I'm not making light of this, really. I mean, obviously, we don't like to get caught up in regulatory and legal overhang with any of our names. But in the case of Visa, it sure seems like some of that risk just this week was probably already discounted. And Visa has a lot of levers that they can pull. Of course, they vigorously denied it and classified the suit as meritless. Even if it does has merit, like I said, it may play out over years. So, if you're a long-term holder of Visa, I don't think this really affects your calculus, in my opinion. But obviously, you want to stay tuned in terms of how this develops. If you're looking for an entry point on something like Visa, you may want to stay alert to any price drops as a result of this. Maybe that is a chance to possibly to consider the name. So again, that's what the analysts at Goldman Sachs and RJ are saying. Just want to make sure that you're aware that anytime a company has regulatory risk, you need to take that into account. As I mentioned, I own these names myself, and we own them for clients. So consider that as a conflict. and make sure you do your own homework if you're not a Wise Investor Group client. So hope that was helpful. As I mentioned, we'll start getting third quarter earnings reports as soon as next week. And we'll obviously keep you abreast of any big developments, particularly with some of the names that we own. So we'll get more stock specific for you over the course of October. Hope that was helpful. Stay safe. And as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.